Hi everyone. Let's go over Chapter 5, where we're going to discuss the ideas of inventories and different types of costing. Up to this point, we've been discussing CVP analysis and job costing and assigning costs to different jobs. We're going to take it from a slightly different perspective this time, which is to look at valuing the inventories. Now, we've been discussing the ideas of direct materials, direct labor, and overhead. And the way those are treated for production costing is by assigning them to inventories on the balance sheet that ultimately get transferred to the cost of goods sold when the items are sold. So two general approaches are used for valuing these inventories and the cost of goods sold. One approach is called absorption costing, and that's usually for external reporting purposes. The other approach is variable costing, and that's preferred by managers for internal decision making. Kind of like the way that we would use the external financial reports versus internal ones. We use the contribution one internally for decision making and budgeting purposes. So this chapter is going to show how absorption costing and variable costing differ. It's going to also show us how to create a segmented contribution format of an income statement. Okay, so variable costing treats only those costs of production that vary with output as product costs. So, in other words, we're only looking at the costing as it applies to production at this point, and that's for variable costing. So in this case, if we look at our graphic, we are only looking at direct materials, direct labor, and variable manufacturing overhead, because remember, these are the items that are going to change with levels of activity. And that's why we had to learn product costs. Period costs are treated differently under variable costing. And this comes back to that whole contribution margin idea that we've already discussed. Okay? Now, this supports CVP analysis because it emphasizes the separation of variable and fixed costs. For simplicity, nearly every example that we're going to look at in this chapter treat direct labor as a variable cost. However, remember that labor is commonly a fixed cost in some companies, and under variable costing, direct labor would not be included in product costs when it is a fixed cost. We'll talk about this a little bit later when we discuss a concept called theory of constraints at the end of the chapter. Okay, fixed manufacturing overhead, both variable and fixed selling and administrative expenses are treated as period costs under variable costing. The only difference between variable and absorption costing is how the two methods treat fixed manufacturing overhead costs. Under both methods, selling and administrative costs are period costs, both fixed and variable. If you look at our graphic here, The period cost, the bottom two blocks here, variable selling and administrative and fixed selling and administrative, are both at the bottom. They're always considered a period cost. It's how the fixed manufacturing overhead is treated, is the big difference between variable and absorption costing. Again, remember, variable costing is used for internal purposes. Absorption costing is used for external purposes. So absorption costing treats all cost of productions as product costs, no matter if they're variable or fixed. So this is not well suited for CVP computations because there's no distinction between variable and fixed product costs. Okay, so let's jump into this, and we're going to look at an example. Okay, so we're going to look at the Harvey Company, and we're going to assume that the Harvey Company produces only one product with this information on the slide. So, based on this information, the number of units produced annually is 25,000. DM, DL, and variable overhead are $10 per unit. Selling and administrative is $3 per unit. And then we have our fixed costs per year. Alright, so under absorption costing, all production costs, variable and fixed, are used when you determine the unit product cost. So absorption costing is in blue here, since we are looking at the fixed manufacturing overhead as part of the unit product cost. We have $16 per unit. Under variable, remember, we do not consider the fixed manufacturing overhead, so it would only be $10 per unit. Okay, so let me give you a quick reminder before we move too much further forward. There's a relationship between ending inventory and net operating income. Higher ending inventory results in higher net operating income because cost of goods available for sale less the ending inventory equals the cost of goods sold. Therefore, a higher ending inventory results in a lower expense, the expense being cost of goods sold, deducted to arrive at net income. So in English, if you have a higher ending inventory, you will have a higher net income. Okay? Since you're deducting less from it. All right, so taking this idea, let's go on to look at some income statement for Harvey Company. Okay, so here's our assumptions. We sold $20,000 units during the year at $30 each, and we have no beginning inventory. So let's compute net operating income under both absorption and variable costing. All right, let's start with variable costing. So we're going to look at the red spots on this slide. We have sales of $600,000. We have variable cost of goods sold with the variable manufacturing costs only of $200,000. That's 20,000 units at $10 per unit. Less variable selling, add variable selling and administrative expenses of $60,000. So that gives us a total variable expense of $260,000. So our contribution margin, sales less variable expenses, is $340,000. Remember, the contribution margin is what is available to cover fixed expenses. So now we would put in our fixed manufacturing overhead and fixed selling and administrations. It gives us a net operating income of $90,000. Remember, this is the internal method. Okay. Now, let's look at this from absorption or an external perspective. So here we have sales, again, of $600,000. Now, since we are including the fixed overhead into the computation to get to our gross margin, we have a cost of goods sold of $16 times 20,000 or $320,000. Our gross margin is now $280,000. And now we look at the selling and administrative that needs to be covered, and we have $160,000. If our now our net operating income is now $120,000. And our fixed manufacturing overhead deferred in inventory, meaning how many units are left in inventory, is 5,000 units times $6 per unit, or $30,000. Under absorption costing, the recognition of fixed costs as an expense is really timing. When the items are sold, the fixed cost will be reflected on the income statement as part of the cost of goods sold. So let's compare these two methods. Under absorption costing, $120,000 of fixed manufacturing overhead is included in the cost of goods sold, and $30,000 is deferred in ending inventory as an asset on the balance sheet. Under variable costing, the entire $150,000 of fixed manufacturing overhead is treated as a period expense. The variable costing ending inventory is $30,000 less than absorption costing. And that explains the difference in net operating income between the two methods. The difference in net operating income between these two methods can also be reconciled by multiplying the number of units in ending inventory, or 5,000 units, by the fixed manufacturing overhead per unit of $6 that is deferred in ending inventory under absorption costing.
Okay. So we're going to, let's take this just a little bit further. Some additional assumptions and facts. 30,000 units were sold in year 2. The selling price per unit, variable cost per unit, and total fixed cost and number of units produced remains unchanged. Now, that 5,000 units in ending inventory becomes 5,000 units in beginning inventory for the next year. They just carry over. Okay, now let's keep moving with this. Now take a look at how the variable cost per unit, total fixed cost, and the number of units produced remains unchanged. And so therefore, the unit cost computations also remain the same. Okay? Okay, so variable costing format income statements. Take a look at the red pieces here. Variable cost of goods sold is the number of units sold times the variable manufacturing cost per unit, or $10. So 300,000 in variable cost of goods sold, and that $3 variable selling and administrative expenses likewise remains the same. Under variable costing, all fixed manufacturing overhead is expensed. It's treated as an expense. We can't recover things like the manager's salary or any of those other pieces. So under this method, the net operating income is $260,000. Now, let's look at it from the absorption costing perspective. Now, what changed is our cost of goods sold, because we are including the fixed manufacturing overhead per unit. And just because of the reorganization of how we classify these costs between variable and absorption costing changes our net operating income. And this is just how it's done. Remember, absorption costing is for external purposes. Variable costing is for internal purposes. Okay? And if we compare the two, we notice that the difference really, if you put it side by side here, 260,000 under variable costing for their net operating income, and the 230,000 for absorption costing net operating income. The difference is 30,000, and that's your fixed manufacturing overhead of 5,000 units that was in the beginning inventory at the start of period 2 times $6 per unit. Okay, so does that make sense? All we're looking at is the difference of how we treat the fixed manufacturing overhead and how we're treating our beginning and ending inventories now. Okay. And this takes it a little bit further, assuming that we haven't thrown anything else into the mix. At the end of the second period,
we have the same totals. Okay? So, a summary here of what you should know. When the units produced equals the units sold, the two methods will report the same net operating income. Okay. When units produced exceed units sold, you have an increase in your inventory, and absorption income is greater than variable costing income. Likewise, when units produced are less than the units sold, you have a decrease in inventory, and your absorption costing income is less than your variable costing income. All right, now let's bring our old friend CVP back into the mix. Variable costing categorizes costs as fixed and variable. So we can use this income statement format for CVP analysis. There should be no surprises here. Absorption costing assigns per unit fixed manufacturing cost to production. This can potentially produce net operating income even when the number of units sold is less than the break-even point. So what does that really mean? Absorption costing, because of the way that the fixed manufacturing overhead is treated, can potentially yield a net operating income that is positive even though we didn't produce enough units. That has to do with the way that the beginning and ending inventories are treated under absorption costing. Okay. Now let's explain some changes in the net operating income. Under variable costing, we only are looking at changes in units sold. We're not looking at the number of units produced. We're looking at the number of units sold. It is all based on cost of goods sold. Okay? Absorption focuses on changes in sales, of course, but also changes in production. Net operating income can be increased simply by producing more units, even if we don't sell them. So really it comes down to, under variable costing, we are only looking at changes in unit sales. Okay, so think about that from a managerial standpoint and how we really want to focus on the movement of units from production to sale. Variable costing and the whole contribution margin are driven by the number of units sold. So let's revisit our old friend decision making. Variable costing identifies the additional variable costs incurred to make one more unit. It emphasizes the impact of fixed cost on profits. Absorption gives the impression that fixed manufacturing overhead is variable. Now that I know sounds kind of crazy and backwards, but that's the impression it gives with respect to the number of units produced, but it's truly not. It can lead to inappropriate pricing decisions and product discontinuation decisions. This is why a variable costing approach is used for internal purposes, so that you can make
proper and appropriate CVP-driven decisions.
All
Right. Now, let's go on to an idea of decentralizing operations and looking at different segments. Whoops, let me scoot back there. Okay. So when we look at segmented income statements, what we're talking about is a part of an activity of an organization about which managers want to know cost, revenue, and other financial data. So think about where you work right now. Where would be some logical segments? Do you have other branches? Do you have departments? Do you have whatever else you can break your sections down by? Okay, that's what we're talking about when we say segment reporting. Okay, so 2 keys to building this segmented income statement. A contribution format should be used because it fosters calculation of the contribution margin. It allows you to see just how much the segment is contributing to the coverage of fixed costs. And traceable fixed cost should be separated from common fixed costs. So for instance, let me break that into English. If, for instance, we're talking about 2 different geographical divisions, so we have a division in Cincinnati and a division in Salt Lake City. Some common costs that they might have would be the people in the home office, like the accounting department, or sales managers for the entire company, whereas some of the segment costs would be people who work at the Cincinnati and Salt Lake offices. So traceable fixed costs arrive because if we got rid of one of those segments, then we wouldn't have the costs associated with that segment. So say we want to ditch the Cincinnati segment, okay, all traceable fixed costs associated with the Cincinnati segment would go away. We wouldn't have a manager for that unit. We wouldn't have labor or overhead costs for that unit. And that's what we're talking about when we're saying identifiable fixed costs. Okay? Common fixed costs would arise because we still need a company president, and we still need a general accounting division. Okay? And so one of the ideas here is traceable fixed costs of one segment may be a common fixed cost of another segment. So to give here an example of a plane landing, we can trace the landing fees to a specific flight, but we can't trace it to the passengers who choose to be in first class, business, or economy classes. Okay? So a segment margin, which is computed by subtracting the traceable fixed cost of the segment from its contribution margin, is really the best measure of the long-term profitability of a segment. And this is where we're going to change the way we look at income statements. We're going to break them down just a little bit further. Okay, so a couple different things. With fixed costs, we don't allocate common costs to the segments. In other words, we're not going to assign the president's salary to a segment. So here we go. We got two divisions for Weber Incorporated, computers and television. And so the television, we get to look at, here's our variable COGS, which is cost of goods sold, okay? And other variable costs, and it gives us a contribution margin and traceable fixed costs, which leads us to the division margin. In other words, how much is the sales less the traceable and variable costs? How much is left to cover the common costs of the company? So we're going to use a contribution format, and that's what this is looking at. We're looking at what would be left to contribute to covering the cost of the entire company. And so looking at it now side by side, you can put together what's the division margin for each division, company, television, computer. And if you add the right two columns, you get to the left column, of course. And if you look at it, the television sales are significantly more than the computer sales, but the division margin really isn't that much different when you really look at it. So common costs, again, should not be allocated to the divisions. These costs would remain. So let's say if we wanted to get rid of the computer division, the television division would have to absorb all of these common costs. Okay. So fixed costs are traceable to one segment, can become common if we make smaller segments. So let's go back to our example here and see how this works. Okay, so here's our product lines within the television division. So we now have regular TVs and big screen. Okay. Now if we break it down, we notice that we have a product line margin of $60,000 in the regular, $10,000 in the big screen. Cool. Looks like our regular is making more money to contribute to common cost coverage. Now, all we've done here is we've added the figures for the regular and the big screen and brought them across. Common costs are $10,000. The entire television division's margin is $60,000. All we've done here is take the division's financials and divide them even further into regular and big screen. Now, the whole purpose of this is to make decisions easier. Remember, managerial accounting is about planning, controlling, and decision making. This has to do with the decision making end, and it also has some to do with the controlling end. We want to know, are our divisions making money? Where are we losing it? And by breaking it down into segments, we can isolate where any problems are and then make plans to either strengthen the segment or remove it. So this breaks it down even further into kind of a what if we have more sales, what if we put more money into advertising, what happens to the segment income. Okay? So this is where it's a wonderful tool, especially if you use Excel, to decide what
will happen under different scenarios. And you can prepare many different suggestions. If you need to give options for, do we keep it this division, do we axe this division, and breaking it down takes it from being an intuitive, kind of guess-based decision, because we don't want that. We want data, and this gives us some data. All right, so now let's take this back to our idea of a break-even point. And so we're going to go back to this income statement again. Here we are, television, computer, net income. And where is our break-even point now that we've got multiple divisions? And so our break-even point is computed by dividing the sum of the company's traceable fixed costs and common fixed costs by the overall contribution margin ratio. Let me show you how that works. Okay. So, take a look at this, 170,000 and 25,000. Where did that come from? It's right here at the traceable fixed costs and the common costs. Okay? So going back, our contribution margin ratio is 270,000 over 500,000. How do we get that? It's the 270 in the contribution margin over the sales. Okay. And so when we add that together, we get 0.54. Now when we do the traceable and the common cost divided by 0.54, our break-even point is $361,111. So this is, just the break-even point is computed by dividing traceable fixed costs and the contribution margin ratio. Okay. Now we can play with the numbers a little bit further and say, what's the contribution margin ratio per segment? And what's the break-even point per segment? Using the same approach. Get your CM ratio and then divide the traceable fixed cost by the CM ratio. Notice the 25,000 of company-wide common fixed costs are excluded from the segment break-even calculation because these aren't traceable costs. We cannot use things like the CFO or the CEO's salary as part of a decision to keep or lose a segment. It just doesn't make sense. Costs assigned to a segment should include all costs attributable to that segment from the company's entire value chain. And so this illustration gives us a value chain: research and development, product design, manufacturing, marketing, distribution, customer service. Okay? Those are all of the value chain. So some problems you can run into, here's an example with 4 segments, is failure to trace the cost directly and an inappropriate allocation base. That better sound familiar from last week's discussion of predetermined overhead, where we were looking at the base to come up with the overhead rate. Same idea. Find the correct allocation base.
Common costs should not be arbitrarily allocated to segments based on the rationale that someone's got to cover these common costs for a couple reasons. It could make a profitable business segment appear to be unprofitable, and it doesn't make sense to make manufacturers responsible for costs they cannot control. All right. So here, I'm going to scoot past this slide. Where are we going? Hang on. Let's go here. Here we go. Okay, so company-wide income statements. So back to the whole idea of absorption versus variable income statements. The absorption ones are required by under GAAP for external reporting purposes. So it means that you're going to have a couple different types of reports, one to file with governmental entities and external parties, and one for internal reporting. So back to this idea, variable versus absorption. Variable does not consider fixed manufacturing costs, and absorption does consider them. Now, this whole idea, bringing this out to a big, 50,000-foot view of what's happening here. GAAP and IFRS, the generally accepted accounting procedures in the United States. IFRS is International Financial Reporting Standards. They require publicly traded companies to include segmented financial data in their annual reports. And the reason for this is so that external parties can make appropriate decisions based on the disclosure of all relevant information. Okay? And that takes us to the end of our Chapter 5. Have a great week.